Today we're mastering position sizing, or we're at least attempting to do so. And so in a nutshell, position sizing is really the total number of currency pair units that a trader invests in. And our size is what's being purchased, if you will. So when we do this, we consider our account size and our own personal risk tolerance to decide our position size. And we can have this nice little neat chart that David made. Probably took him like 4 days, but we won't comment to that.
Well, you're not sharing your screen though.
Are you sure? What? Yeah, I was gonna ask the same.
But I made it. It took me 4 days to make it.
I swear to God, my degree is in computers, and it is the most difficult thing in my life. Where is the share screen? There it is. Is that any better?
There we go.
Definitely see it. Yes, sir.
I swear I'm not completely incompetent, just partially. Okay, so now that you see this nice little chart I've been speaking to for the last 2 or 3 minutes, I was kind of going over the left and the right of this, where we're talking about the balancing of our account size and our own personal risk tolerance. And as these two things increase, as you can kind of see from David's little chart, as your stress and anxiety goes up and your performance goes up, you get this nice little bell curve. And there's an ideal position size right there in the middle. One thing that we never do is, and I've learned this the hard way after blowing several accounts or just being greedy and taking a hit it takes me 3 weeks to recover from, never increase your position size for any other reason like greed, for example, because that's basically gambling. And as fun as it is, and we all do like to do that, we got to keep that in Vegas, because with trading, you'll end up taking a big loss every time. I've never gone a streak of increasing my position size based on greed without hitting a big loss that takes me weeks to recover from. And that is where you're losing all your money for the week, the month, or whatever. And we're trying, the objective in trading is, of course, consistency. So position size is one of the tools that allows you to keep consistency. And let's see. So we've all heard David discuss pretty much what you're comfortable with versus what really moves the needle for you. And that is, in a nutshell, position size, that is essentially what this is. So, and I think, is Duke here? Oh yeah, okay. So Duke's gonna get mad at me. So I'm gonna use Duke and Nick as an example because they are the polar opposites that I keep kind of bouncing between, trying to figure out, does this work? No. Does this work? No. But hopefully he won't be too mad about it. But for example, like Duke, he wants to move the needle on every trade that he makes, right? And he's honing these sniper skills that he has, and because he's found that that's really what works for him. Nick is on the other side of this and is perfectly comfortable really just collecting pips from his setups, right? He's just kind of wandering through the garden collecting his little pips.
He's frolicking.
He's frolicking. But the point is, they both end up making money. But they're like all the rest of us, they're trying to figure out, like we have on this chart here, what is it that, like in Duke's, for example, moves the needle for me to get my position size, to keep me in this optimal performance zone. And the same with Nick, and the same with all the rest of us. It's what moves the needle, which is the left part of this, where you see this big gray bar. Mm-hmm. The left part of this is what's moving it enough to get me in and doing this every day and paying my bills or whatever. And on the right side of it is, okay, well, this is too much. I'm getting stressed because I'm wrong, or I'm taking too big of drawdowns or whatever. This is where your emotions and psychology kind of start to kick in. That means you're too heavy for you. So let me see.
I like that. That makes a lot. You got to find what works for you, right? Remember when we first started, I remember with Trader, but they were aggressive, right? And had to feed that nature, right? But learn how to be within, I guess, that risk management box, right? To do so, or your own risk management box. too. So
It does. And for me, back to the gambling part, like when I started trading and I catch myself doing it, I still catch myself doing it because like, oh, I got this figured out. I'm just going to throw 5 lots over here and make $1 million. No, that's gambling. Every time it destroys my consistency. But, and there's a lot of analytical people in our group. So I've thought about that a little bit. And I wish I could say, or I may not be intelligent enough to say, but the best I can figure out about position sizing is it absolutely comes down to a balance of interest and stress. I have not seen or found, aside from YouTube, which has every quack on the planet, there is not a simple formula for if you have X amount of money in your account, you have X price cycles, or you have X anything equals X position size. That does not work. Now there's some guides, and I'll give some guidelines in a couple of slides about what can help you get started to help you figure out your position size. But there is no magic formula for that. So this is where you really have to know yourself as a trader. And what do you like? Where are you comfortable? Also, keep in mind, what are your skill levels? What techniques do you have in your pocket? Because knowing these things will tell you your optimal position size for the market that you are in right now. And things to also consider are, how's your day so far? Did you get good sleep? Did you eat? Are your bills due? Is someone in the family sick? Do you want to buy a big old car, which is influencing your decisions today? The psychology piece really does affect us when we sit down and trade, and messes up your position, your objective assessment of your position size and balancing this for the day and the market that you're in. And so, and like I say, I still do this all the time. And, you know, people's first reaction, because I do this full time, is, oh, well, I've mastered it, I must be loaded. And it's like, no, no, absolutely not. I make my bills.
not yet, right?
Yeah, not yet. But so every time I sit down, I have a process I go through to get rid of a lot of that stuff, because I know I've still got bills to pay. So instead of bringing that to the trading table, which I used to do, and would cause me inconsistent behaviors like gambling and that sort of stuff, I've implemented things into my pre-trading session to get rid of it. I've got a garden outside that I water now. I ate a plum. I had my first plum off of a tree that's like 7 years old. It was really good. Of course, the worm had half of it, but I cut him out. It was fine. But if you can figure yourself out and you can put these things into place to help you manage your psychology, because you're not going to manage life. We all got bills to pay. We all got wants and needs and that sort of stuff. You're not going to change that, but you can change how you approach it and how you manage it before you sit down to do trading. And so, actually, I caught myself for an example about 2 or 3 weeks ago. I held a trade 2 seconds longer than I knew I should, a whole position that was really heavy. And because I knew that if I got one more pip, I'm still mad about it, obviously. I'm still bitter about this. If I got one more pip, my entire month's bills would have been paid, and all the trading the rest of the month would be spending money or savings to another account, right? Never got that pip, and I risked out. Right. So that is what psychology does to you when you're trading. It's not like you're sitting there going, oh, I can just do this and that or whatever, and I feel like this. It's in the back of your head, silently eating at you and not letting you, or holding your decision to get out when you know you're supposed to, long enough for the market to take it back from you. So we really have to get a handle on our psychology and how we sit down before we start trading.
I'm excited to hear it. I need it.
But like I said, we have some guidelines to help with the position size, and I'll go over those in a few. Does anybody have any questions over this first slide in this little chart? Oh, there's chat. I don't know, James, are you watching chat to help me pull out questions?
Yeah, no, yep, I got you.
Okay. Yeah, I'm with Joe. So yeah.
Yeah, no, on the chart. So yeah, no, so far.
Yes, Martin, it's really biting me. I'm really mad about it. But you know what? I haven't done it since. When I'm supposed to get out, I get out. Okay, so On the next slide, this was the teaching methodology thing of David, see one, do one, teach one. So you want me to go over that, David? Because this is the reteach of the hot seat. He's muted.
Mhm.
Can't you read lips? Come on.
I can
said-
barely read candles.
I said yes, because this one, this is actually going to live
Yeah.
on YouTube. So those people
Okay.
who are just watching it, will explain
Okay.
what the 3 and 50 is, and see one, do one, teach one methodology is, like to people that are watching this for the first time.
Okay, so no problem. So this 3 and 50 thing is actually pretty cool when he started with the hot seat. And he's basically implemented this see one, do one, teach one philosophy, which we got from one of the traders that we love. And I forgot the lady's name. What was that
Debbie.
lady's name? Debbie, that's right.
Mm.
We got it from her because she's really cool and we all love her. And then we just like ran with it. Anyway, so basically your first, once you do this hot seat thing, you first learn the concepts, then you apply them in practical situations. And of course, then you teach them to others, which is what I'm trying to do here tonight to cap it off. And throughout this program, we incorporate, what's being termed 3 and 50, which emphasizes that there's always 3 things to remember when learning a new concept and the importance of the 50% rule in the market. And the market usually behaves also in 3, what's the word I'm looking for? It repeats itself like 3 times. Or it's the 3rd time it does something. It's
Cycles is a good one.
cycles. Thank you. Yeah, Jeremy. It always does like 3 cycles of something, whether it's a pattern or a behavior or anything. You see it 3 times. You can kind of make decisions off of that.
3 levels of traders, right? With the individual areas that we need to really have a handle on before you progress to knowing when you know.
Oh, that's a good point. Okay, so it wouldn't be a presentation if I didn't have some kind of racing in it. Oh, whoops. So I tried to make an analogy on racing versus position size. And it was pretty easy, actually. And you had to forget NASCAR because that's a circle and that's not what trading is. Trading is not that simple. So it's really more of a Formula One style. And it's got ups, downs, lefts, rights, circle rounds. It's actually driving. So position sizing itself is not a constant. Even in a trading session, when you sit down, you don't want to keep it constant. So it's not a nickel or a dime every time that you sit down and trade and you magically make money, because the market will change right in front of you, especially if you sit long enough. The longer you sit, the more it's going to change. And so an analogy with the racing is that you have different tracks, right? And every weekend you have different turns, you have different temperatures that affect the track cohesion and thus your traction. Well, to start there. So let's break that down. If you start racing at 5 or 6 o'clock in the morning, which we trade 5 or 6 o'clock in the morning, you have this nice cool weather and the track is nice. It's cool. The car is nice and cool. Your speed is faster because the cooling temperatures cool your car off and connect well with the hot tires. And as it's cooling them off, it maintains a good cohesion level. So you can go faster. You can have a higher position size in the morning before everything wakes up. And as the day goes on, noon hits, temperatures get hot, especially here in Texas. We've got track temps about 170, 180 degrees. That's transferring to the car. Car is hot because it's been running all day. It's sluggish because it's heat soaked. Everything's soaked in heat. And you got to lower that position size. You got to lower your speed. Otherwise, you either risk out in trading or you risk going off track because your tires are melting and you slide off. Evening comes back around. Cool breeze comes back in from the night air. Everything starts to cool off again. You can pick up higher speeds. You can pick up higher position size in the night because the market cools off as well compared to how it starts in the morning. And so basically for translating that into trading, when we start in the morning, we're trading the late London session. So it's pretty calm because people are preparing really for New York when it opens. Actually, I think when we start at 8 a.m. here, New York's already open. But the transition from London to New York, especially towards the close and opening, is a bit it's a bit different. It's a bit lighter. And price cycles and accordings are usually smaller, so you can have a higher lot size. And you can let me see. My brain went somewhere and I don't think I followed it. So because we're going between like London and New York, you can have a little bit lighter lot size. But then when New York opens, especially the New York Stock Exchange, which is right at our time, you get some more buyers and sellers into the market. So it starts to increase volatility. And then, of course, you get all the news, all that stuff starts to hit. All these people are coming in. So you can translate that into the heat coming out of the track. As that starts to happen, your price cycles and everything increase. So you will need to lower your position size as that occurs and be able to see it in real time. And let's see.
I really like how you said that. And then, I didn't know that. Price, if price cycles are, I think it's a good rule to go by anyways. Price cycles are small, then you have it more likely going to increase your lot size. As volatility increases, you get bigger price cycles. Always, best to kind of stay a little bit light, right? And
yeah, and it's kind of, I view it kind of like adding heat to the track.
Right.
As the sun comes up, as the markets open, like New York Stock Exchange, the COMEX, all this stuff starts opening its doors. The sun's coming up, the track's getting hot. You got to slow down. As those things start closing, like when New York closes, when London closes, which is like during the morning session, and then London closes in the afternoon, and you got Australia and Japan opening up, they're just not as hot. They don't have as much heat. So you can have at nights, especially, you can have much larger position size. And it's because of the price cycles being smaller.
Hey, Josh, can I ask a question? This is Megan.
Hey, Megan, yeah.
So how do you feel about increasing your position size when you're down so that you can make more ground back?
So that can be a double-edged sword in my experience. But as far as and David may correct me some here because he's seen me screw up, but as a matter of course, I don't recommend it. I recommend sticking with your lot sizes you've been trading so that you can manage your position in your whole setup. However, with that said, when you see a high probability setup, and everybody needs 2 or 3 high probability setups in their pocket, that's what I said, going back to knowing your tool sets and knowing your skills and your ability to use them. When you're down, start really watching for high probability setups to clean that up. And at that point, you can either go heavier in one of 2 ways. You can increase the lot size, but that means you put on fewer trades. Or you can put on more trades, which kind of also increases your position size abnormally for that layer. But it is going heavier for the purpose of cleaning out that drawdown. But I only do it on high probability trades, not as a course of normal setup, because that just seems to get you in trouble.
And I think you said a key phrase there. You put on fewer entries.
If I increase the lot size, yes.
If you increase lot size, don't go heavy on the increased lot size.
Yeah, and it's there's actually a pretty good little,
Okay.
there is a pretty good little mathematical concept there, and Joseph probably can term it for me. But the whole objective of, or kind of at the crux of everything that we do is kind of a wobble and kind of a setup. It's a modified one, but it's at the foundation, right?
Right.
One of the main foundational pieces of it is keeping that break even close, because we keep talking about keeping it within one price cycle, all that kind of stuff. You'll want to add enough positions, and you have to make the decision yourself whether it's an increased position size or just more layers or more trades itself. But either way, you are in deeper than you normally would be, as a matter of course. But whatever it takes to get that break even within a one price cycle move for you to pay for that debt or that drawdown. Not to gamble, not to go, oh, well, I'm just going to throw it all here or risk out.
Mm-hmm.
It has to be an educated decision. Does that make sense?
Mm-hmm.
Okay. Does that answer your question?
Yes, thanks.
Okay.
That explained a
you
lot
guys-
for me too. Thank you. Yeah.
Okay. Anybody have any questions around how it relates to heat on a racetrack?
Oh, beautiful analogy. I saw the clarity.
Well, it kind of feels like heat when you're,
Mhm.
when you're in
Volatility.
drawdown, like Megan's talking about. You feel like your butt's getting a little warm.
Well, and you know, this is really, I guess, you know, maybe the guidelines, right, to helping you understand that, you know, how are you really making an educated guess and fixing it, or are you just getting greedy, right, and want to get that money back?
And it goes back to the initial thing right here. If you're being greedy, you're probably bored or trading too small, or you're just not interested enough in what's going on right in front of you. But if you're stressed out because you're in the drawdown and you're starting to panic and you're starting to decide, I'm going to throw on more trades just to get out of this drawdown, you were too heavy to begin with. So don't pay attention to those things that you're telling yourself. Those will tell you for the next trading session, at least, or your next position that you get into, adjust your position size for this type of market because you were wrong. Because you're either stressing out or you were bored. And
And the 3 and 50, right? They had the 3 pieces of that. Yeah. Yep.
Okay, so market price, or excuse me, market structure and price action. Market structure. I used to think this was really, really complicated. And I thought there was some magical answer reading from the damn market, or excuse me, from the market structure. It is so simple that maybe it is complicated. It really only does 3 things ever. I took away the slide. Can anybody tell me what those are?
Consolidation, 1, right?
Yeah. Yeah.
I think I know them, but I just seeing if anybody else
Up, down, and
has
sideways.
Yep, down, sideways. Yep.
This is literally the only thing the market ever does. Well, besides go right, which I have been right on 100% of the time, but for the record, I haven't made any money off of that, but I've been right. It either consolidates in a range, like you got right here, or it expands. That's it. And it either expands up or it expands down. And then once it's done expanding, it goes sideways again. That's all this thing does. And I myself complicated it to a point that I studied it for months and didn't really learn anything other than all it does is consolidate and expand. That's it. So the thing about it, though, is that market structure is the key to your entire strategy of what you're doing, your entire plan, because that is what tells you where the odds are. Not necessarily where price or prediction of the market, but what the odds are about it going up, down, or sideways. For example, if you're making lower lows and lower highs, we're in a what?
Bearish market.
Yeah, we're going down.
Downtrend.
We're expanding down. The trend is down. There's a lot of ways to say that. If we're making a higher high and a higher low, uptrend. We're in a bull market. That's it. If we're kind of making the same highs and same lows, we're in a consolidation. And Davis started doing this every morning, is going over market structure because of how important it is. But it's so simple. We just don't do it sometimes. But if we're in this range down here, and when we walk onto the computer or when we open the computer, we don't really walk on it. They're expensive. But we open the laptop and you're in this consolidation. Your key price indicator, KPI that we've been calling it, is this dot right here. Because if it breaks that, you're out of your consolidation, you're out of your downtrend. Your sell strategy is going to lose. And so you draw a line right there. That's it. And then what happens? And you do win while losing, you flip into buys and you go back to making money. And there's a bunch of ways, there's a bunch of tools that we've got in our tool belt to do that, win while losing, other various things. But those are other conversations. The price action piece. So I Googled this because we talk about it all the time. And I wasn't 100% sure I was saying what I thought I was saying. But basically, according to Google, by definition, this is the movement of a security's, Forex, price plotted over time. That's it. There's a whole lot of reading into that, but by definition at its base, price action is the movement of a security price plotted over time. And so in Forex, we make it a technique that allows us to read the market and make subjective trading decisions, right? Based on the price movement, especially historical price. So as the price goes to the right, we're making decisions on all this old stuff. And this is the price action. What we, as Forex traders, convert price action, prices plotted over time, into. And so let's see. And there's actually, now that I think about it, all the indicators that we use and that sort of stuff that are on the market, because they're based on price action, they lag because they have to wait for price action to occur before they can draw out what they're indicating. So really, yeah, if you use indicators, you miss the opportunity, which is why I like the wobble technique. But that I'm straying there. Oops, where'd I go? Oh, right there. Okay. The other thing that I wanted to point out is that levels and consolidation. Well, I just did that. Okay. Does anybody have any questions over market structure and price action?
I like that definition and your kind of take on it for sure. But no, I think we're good.
Okay.
You're doing a great job. Everybody's understanding we're all going to be millionaires now.
There's a guarantee, and if it doesn't happen, knock on Jimmy's door.
That's a Charles Barkley guarantee.
I heard something today that I thought I'd share, that it probably I can teach you somebody said that I can teach you the mechanics of how to trade in about 6 months, but it'll be a lifetime to understand it mentally, on the mental capacity of how to trade. So I thought it was kind of interesting. Takes a lot.
It is, and I may just be at the point in my trading career that I think the reason for that is you got to figure out yourself.
Mm-hmm. You got to figure out what works for you, for sure. And you can have tools, and there's plenty of tools out there, and you can utilize the tools. Position sizing is just one of those tools, you know.
Yep.
But it's a very important tool.
Okay, so calculating position size based on price cycles. I also Googled the price cycle because I really didn't want to do a presentation where I didn't know the exact definition of this stuff. But so a price action, or excuse me, a price cycle is basically how much a price has moved in a cycle. That's it. I have to keep things simple. I'm not smart enough for complicated definitions. So for us, that's basically from pivot to pivot. Let me see. Sometimes this works a little bit better without the slide. Yeah, okay. So, and I use the pivot indicator, but this may help. Let's clear on this. See, these are the little pivot indicators that Alveo has. And price cycle is basically measurement of that point, that point, that point, that point, yeah, kind of down to that point. That's a price cycle. That's it. That's all there's to that. Pivots, that's these things right here. Oops. These are pivots. Yeah, it's kind of a pivot area. There's a good pivot, right? These are basically, and I do like pivots because these are some absolute truths in the market. A pivot is where price always pivots. Excuse me. So it always moves from pivot to pivot, and a pivot is, you know, it's going up, it pivots to go down, it pivots to go up, it pivots to go down. So it's always, the market is always, you know, going to expand, consolidate, and go to the right, but it's also always going to move from a pivot point to a pivot point. These are things that yeah, right. That's right, Cliff. It's changing direction. And then and on the 1 minute, it was going up, and that's going down, then it's going up, then it's going down, then it's going up and down. And so what we can do is take that guarantee that it's going to go from pivot to pivot and make a price cycle out of it.
Mhm.
The trick though, is you never know when it will pivot. And pivot points can be redrawn based on price action, because even the pivot indicator is an indicator. It comes later and it can be redrawn. But like I said, what we do know is that price will pivot, and there is a lot of value in that itself. And so if you look at it historically for the price cycle, which we can do right here, and you take your little tool that's right here in Alveo and make this little crosshair, and you can just measure them. 10 pips for that one, 10 pips for that one. 4, 7, 5, 5, right? I got to fly. So based on that, and every time you come in and you kind of check out your price cycles, we do have guidelines for actual position size. But I wanted to talk about pivots and price cycles before giving it to you. So if you have a pen and paper, it's probably a good idea to write this down. I had to write it down.
Mhm.
For like a $5,000 account, if you want to trade a light, if you want to start with a normal trading setup on a normal market condition for you, like this one might be a good normal market. It's 5 pips is pretty good, healthy little market right now, honestly. 5 to 10 pips is a normal market. Less than 10 pips, you would want to, that's a lighter position. Greater than 10 pips, you would want lighter positions. 5 to 10 pips, you would want normal positions. And if they're less than 5 pips, you can go heavier positions. But remember, that is a basis for you to start figuring this out, for you to start mastering your position size. So if you're in a normal market, you got 5 to 10 pips, you can trade normal position size. So as a good guideline to get started, and everybody's like, okay, Josh, well, what is the normal position size? And the normal one on a $5,000 account that you should be able to manage pretty good is a nickel, or 0.05 lot sizes. Lighter, so if it's greater than 10 pips, try 0.02. And if it's heavier, try 0.10. And if it's heavier, it's got to be less than 5 pips between the price cycles. And that's a good starting point. But as you trade it, and as you trade your setups within the market structure and your price cycles, make sure those numbers keep you in this gray box right here. If they don't, if you're trading 0.05 because you think it's a normal market condition and you get stressed out several times during your trading, it's too heavy for you right now. Knock it down to a 0.04. Try that. If you still get stressed out because you get that drawdown, like Negan was talking about a minute ago, lower it a little bit more until you get your skills and your tools up to where that doesn't give you anxiety. And as you trade and it moves you to this boredom is not moving the needle, this Duke side, then you can increase your position size. Does that make sense? And this is how I recommend you figuring out what works for you in the market you're looking at.
I'm just amazed at how much I'm learning already, guys. And I'm very I like the analogies, and I know I've heard you say it before. Dimes, nickels, and pennies, right? And that kind of just registers with me, right? And then the breakdown of the the 10 pips or more, so heavier. What do you say, 10 pips or less? Then you go lighter, and then 5 or less, then you go really light.
Yeah, it's a good starting point. It really is a good starting point for everybody. It's 5 to 10 pips. Greater than 10, go lighter. And if you're less than 5, then go heavy. Do what, dude?
James had it all backwards. He said less than 5, go lighter.
Oh, was it? Oh, I thought, okay. So it's less than 5, go heavier. Got you.
Yeah.
Yep. Okay.
Less than,
Less
and
than
the
5.
reason is because the market's not
Thank
moving that much. So in order for you to not be on this board, needle's not moving it for me thing, then you can be in a heavier position and make the same amount of money because you don't need as many pips to make that money. But when the market has those big price cycles, like 5 to 10 or even greater than 10, you really start to put the account at risk with the higher position size because you got all that movement in the price cycle and with the pips. So you lower your position size. And what number that is, and start with 5 to 10 being normal with a nickel, greater than 10 for lighter, with a 2 pence, or excuse me, a 0.02 lot, and then if you're heavier, then do a dime. But make sure that's comfortable with you. And if at any point it becomes uncomfortable, whether it's on the other side of this gray bar, adjust accordingly for you in that market.
Mhm.
Okay, we were here. Let's see.
So there's a question that Daniel asked. He said, so you aren't
Oh.
basing your risk on a percentage of the account.
Okay, so yes, a little bit. But that depends on your strategy. There's a little bit more advanced discussion there. So let me just bring this up because this just makes it easy. Let's say you're analyzing your market, right? Let's clear all this stuff out from previous messes. And I'm starting on the hour to figure out, okay, what's the general gist of the day? The first thing you do is look at the market. You're in a current downtrend. Cool. When does that break? Well, if I get a higher high, here's a major support that it's sitting on. I mean, it's sitting on. So it breaks up here and kind of, if it breaks this, and you just draw these things out, if it breaks that, your downtrend concept is over because you now have a higher high. If it does this little, let's just say, I don't know, Powell opens his mouth and you end up with that, right? And it closes. Now you start doing this. Your down sales are over. So you start figuring out how much range you have to play in. So you measure that. That's like 45 pips. That's a lot of range. So go down on the smaller time scale on the 5-minute. That gives you a general idea of what kind of market we're dealing with. Well, I do hate this time of night. Let's just go somewhere else. Let's just go over here.
It's slow going right now.
Yeah, this one's great. So same concept, but it's a lot more manageable, right? This little range here is 16 pips. And I'm talking about between here and here where it was playing, right? So let's say we're playing that. There's no go there. And this is where you do your market structure now. And take a look. Okay, so it's in a downtrend, sort of. Your hour was a downtrend, 5 minutes of downtrend. Okay, cool. When does that break? Well, right there, it's at risk because that would be a higher high. I mean, it's kind of in a higher high right now, but it's still in a downtrend overall. But if it breaks this guy, nope, that's a structure change. That from playing down here. Your sales down here are not going to be fun if price goes above that point back there. So you just kind of identify those. And we're in this range right now. We're at the top of it, 15 pips. I like to have about 2.5% risk overall because I can make that back in about 2 days for my plays in between here. So I do keep that in mind. And let's see what the price cycle are. No, wow, 3. Yeah, 9, not that great a market. 11, 14. So it's just starting to get kind of heavy. It's starting to wake up. Yeah. So you would assess this of do I feel like this is normal trading for me? Then go with those position sizes. Or do I feel like this is scary trading? Lower your position size. And for me, it would be a little bit scary because it is sitting and just tapping that ceiling. So I would be like, to make on that chart to make me comfortable in that ideal position size zone. Also, and the reason I'm uncomfortable is because we're at the top of this range. Y'all see that? And you see that? Well, maybe not that big. I like the doodling. So right in here would be normal for me, my comfort level. I would trade normally through here. As it approaches this zone, I would lighten because I become uncomfortable. Because if I'm in sales, because of this downtrend on the hour and the 5 minute, I'm at risk of me being wrong and having to deal with that if it jumps up here. So I'm uncomfortable. So I'll lower my position size. Same down here. If I'm in sales, we're at the bottom of this, then yes, it's at risk for breakout down to the bottom, which is cool and I make a lot of money. But if it yeets all the way back up here, that's all those trades I put on at a negative 15 and then risk of coming up here. So I'm lighter down here too, because I am uncomfortable as a trader. And I had to figure that out for me. Also, I think Dave tells us to do that, to be lighter here and be lighter here. But that's why I do it. That answer that?
Yeah, I believe so. You have guidelines, right? That we were just talking about. You have different zones, right? That where I really like how you drew it out right here, because where you are comfortable, right? And having those steps to avoid the, or to help cope with the psychology, right? Of changing those positions.
Yeah. Let's see if any questions. So if I draw down reaches 2.5 to close,
Oh yeah.
no, I don't just, because that's a max loss concept. I don't just close it. I realize that I'm in trouble and I need to start cleaning this up. And I try to close that position at that negative. Not just, oh, it reached my magical uncomfortable number, hit the red X. At that point, it's now no longer I'm in this game to make money. I'm in this game to break even or to clean this up. And it goes back to those tool sets that you've got. Let's say it does break up here and I'm in trouble. We get this little candle and I'm in trouble. You go to a strategy, and I have a win while losing one, which Dave has a couple videos on, for that price to come up here and retrace back to here and clean out. And that my goal is break even. But if it doesn't happen and it goes up to this next one and then it breaks, then I try it again to try and get the negative 2.5 right there. But I don't just close it at the first sign of trouble. I do become more uncomfortable. So I do adjust my whole ballgame. But I don't just. And
I got a question for you.
oh yeah.
Depending on the balance of your account,
Okay.
do you have a total position size of what you would risk allotment when you trade?
I have started trying to figure that out because of you. Like you give us 4 lots on these 5 to 50 accounts. I've started to try and figure that out because that is a really, really good guide on when you're in trouble, especially, and your general concept of the play you're going to do. So if you're going to deal with 2 to get 2 lots to get into the 5 to 50 account on the 5,000, then you really got 2 lots for your entire play. And if you're wrong, the other 2 are to fix it, and that's it, even though we have 10 total. Now, I haven't figured that out on the other accounts because I'm just not that smart, but I'm working on it.
I think that's the next evolution, like position size. If this is 101, then that's definitely 102. Do you know what I mean?
Yeah, and I've tried just taking the math of it. 4 lots to a $5,000 account. How many lots to a $100,000 account, right? But I'm stressed. I gotta find a better word. I want to pee myself when I'm that heavy. So I am way not in a comfortable zone on a higher account using this concept.
What's a good racing terminology when you're like,
you wet yourself. That's why you put towels down. Towels are in the
okay. I don't know if we want to use that I don't know if we want to adopt that terminology. We'll just call it mashed potatoes.
That seems to be a catch-all.
Racing stripes, I like it.
Racing stripes. So that's when you hit yourself.
Now, is that if you win the race or lose?
Well, that's when you hit the wall.
That's when you hit the wall.
So Josh, quick question.
Yeah.
You adjust the number of trades, not your actual position size per trade, correct?
I'm not consistent there. It's sometimes I add because I see a high probability. I'll add positions. I don't change position size because I see a high probability, and I'm like, oh, if I could just move my break even here, and it'll be about this many clicks, then I'm good.
Right, but you're not
However,
adjusting the size of the position on the
on
fly.
that play, no.
Yeah.
However, I do sometimes. If I get a big old like news yeet, then I will have a tendency to double my position size, place the trades, like if it shoots up, like let's say, let me clean this up. I'll just delete that guy. Okay, let's say this happens. Now that's major trouble. And I'm going to be clicking a whole lot up here with the current lot size. So what I'll do is double and click a bunch to get some kind of little click back and then close everything, because that's probably a news and it's probably a mess and I'm about to get in real trouble. But I try to place enough to get my break even above 50% of that move, get that little, what's it called, little bloop down, and then get out and reassess. So I will double my position size on that. But it's kind of, whether I add trades or I change position size, but it is based on what the market's doing. It's not just a rule for me. I haven't figured that out yet. That's what I do.
Thanks.
So
Okay.
it sounds like there's the contingency rules, right? Or how did Dave said to stop the bleeding, right?
Yeah, because I mean, if you're in two lots down here and it yeets up here, you're in trouble. So you gotta clean it up real quick. And that's the way.
Power back from the mark.
Yeah, but if it does this little number, I'm not going to double my position size. I may double my layers or triple them, so that when it comes back down to retest this price, I can get out of the break even. But I'm not going to double the position size because that's adding a whole lot of risk, even though it is high probability. And it makes me nervous.
I think always, just if I can add just one little comment.
Yeah.
I think always with position size, you should always be analyzing your risk versus reward, right? And that should help with your, like, at the end of the day, what's my risk to what's my reward? And I don't want to risk two lots to make, 0.10% or break even. Do you know what I mean?
Right. Right. And so on the other side of that coin, instead of managing your drawdown and that sort of stuff, doubling up on layers or increasing position size, whichever one makes you comfortable on a high probability trade as a course of normal action on a high probability trade adds to your profit, your profitability. That's what I'm looking for. But as a normal course, you don't change. Did I answer your question, Brandon?
Yes, it did. Thank you.
Okay. You wouldn't have had to ask if you had a Mustang, but just leave that off.
You're funny. EMG's eat them for dinner.
That was pretty funny. I laugh at myself more than anybody else does. Okay. So we've done that part. The 3 position sizing guidelines, 50%. So, oh, okay. These things are really good. Let's see.
I didn't know the pattern here with all the references to 3. It's weird.
It is. And there's the 50% and the 3s, the rules of 3 and the 50% are really, they become foundational pieces to my trading, honestly. And I'll just go back to audio. Because when you're making these decisions, let's clean this up. Let me see where to do this. Well, this is a great spot, the current market. So all this stuff happened while I was talking, right? Take a look at your decisions and action points and whether or not to add layers or add a position or whatever you want to do when you're figuring this out. Your range, let me just clear this up. It's playing, well, it's playing between there and kind of back here. Okay, no. Kind of playing between there and right there, right? and you're getting the middle of this sucker right there. All right, so here's your consolidation. It's playing. And what I do is I'll make this red because it's a change in decision. It's a KPI for me. And then this one just kind of sits here. But it sits here because of the 50% rule. That is 50% of this range. Look at what the market does every time it has to make a decision at that point. And this may help you make a decision about more trades, less trades, position size, depends on if you're buying, sells, or whatever, right? Because like right now, it's consolidating a little bit above the 50% of this range, which means your bias, or maybe the bias is the wrong word, your probabilities is to the upside. So if you're in sales, obviously that's going to affect your decisions and your psychology about your decision of being in sales, that sort of thing. But you know you're good until this point. But even on a closer look, the 50% rule applies to everything. This is a range. This is 50% of it. This is an entire price cycle. This was 50% of it. Do you all see that? So
Yeah.
as the market does what it does, paying attention to 50% on every aspect of it will give you insight into probability.
Right, right. No, absolutely.
So as you see it continues to fail, the 50% of the main consolidation, the probabilities do two things. You either, it's going to keep hitting it until it breaks it, or it's going to go to the upside. But because it's consolidating above, that possibility has a higher probability of upside. But now, and like here, I would make that assessment real easy because it broke above one time. It's going to test it. It's probably going to fail based on your 1, 2, 3 rule. Probabilities are up. If I'm coming to the market here, I'm in bias for a little bit, up to here at least. But as it hits it over and over and over, I start to move away from that probability, especially with my position sizing. I put on less trades the more it does this. I don't change my size. I will put on less trades because of this. Because the odds of it breaking down are increasing. And that's the 0, 1, 2, 3 rule. You know, the first time it doesn't, the second time you verify it, the third time it's probably going to break. That makes sense?
There's mud. Yeah, no, it definitely does.
Well, it's recorded.
And what level, I guess, of techniques would you say, that is?
The techniques are pretty advanced. So forget about the techniques as far as position sizing. Forget about that.
Okay.
Pay attention to the 50% rule, because that's a good basic. The market happens in threes, and the 50%, that's foundational pieces. So you know, as this, so look, while I was talking right there, it failed the 50% of this move, probably going down. That can be pretty beginner. Now entries and exits and all that kind of stuff, you're starting to add stuff. But if it fails at 50%, it's going to go the other way. If it passes at 50%, it's going to continue that way. And so with your position sizing, adjust accordingly to keep you comfortable.
A lot of psychology, right? Discipline, right? And
It
practice.
really is the psychology of what David's quote was, what he just said. It really is. And the trend lines and channels and chart patterns we kind of went over. Let's see. Did anybody have any questions on those? I know we're coming close to time. I was going to try and clean it up.
Nope, doing well. You're good to move forward.
Okay. I actually did talk about this earlier. I kind of cheated. So breakouts and bounces, on the resistance and support level, that is essentially, yeah, I got to talking someone over that. That is essentially what we talked about right here. This is your normal zone. create these light zones for breakouts, or of course bounces.
And never go max position size at the bottom of one of those tests. Or the first
No.
test, right?
No. You want to be light, because when you're trading in this zone, you know, you can be normal all day through here. It's pretty good. But when it's down here, you want to be lighter, and you want to be lighter up here because your risk of a breakout is there. And if you get the bounce, then you're going to get a whole, let's say you're buying because you're at the bottom of this, right? Which is not unheard of for us to do. Then you want to be light, because if it breaks down in here, you got to fix that. Whereas if it bounces up, you're going to make a lot of money being light, because it's got 15 pips to move on the one layer you put there. And you got good PTP, which should be like right there. Then it's a really good, low risk, high probability trade. You don't need to gamble. You just need to trade. That's it. But you gotta manage your position size, and I do that one through the number of positions, not necessarily the size itself. I'll continue my normal sizing. I will just put normal positions down there, one layer. Whereas if I'm up here, I'll be heavier, because I don't have that risk of a breakout this way and a breakout that way that I would in those ranges.
I don't, at the risk of running off onto a different tangent, let me ask you this question. How does your take profit help your position size?
I usually trade with a 0 take profit. So I'm going to answer that with action points, if that's what you're looking for.
Well, even still with the 0 take profit, you still have an idea of how much you're going to take profit, right?
Yeah, and I kind of do that with the price cycles. So,
and for those people who don't trade with the take profit or a 0 take profit, they have an idea that they have a set take profit. So whether you trade with a 0 or a take profit, you know what your take profit is, right?
Yeah. So if we take a look at what's happening right now, let me get rid of it.
Again, a risk of maybe like if you don't, I don't want to go on to like a 20-minute conversation.
No, I can answer this in like 30, 45 seconds.
Okay.
I'll go back to the price cycles on it. So if I was trading this, its price cycle is 5. So I'm going to be buying here for getting out here, because that's the previous price. I'm going to be buying down here to get out of here. So I'll manage my risk in accordance with the price cycle of 5 pips. Once the market changes, and now I've got 2 pips. If I come into the market like this, I'm probably going to increase my position size because I only got 2 pips. Does that answer it?
Yeah. Also, because it's doing this, right? Which is a straight consolidation, which it's not going to allow you to build into a larger position size, because it's not going to go against you.
Yeah.
So you're going to be able to increase your position size because it's not going to go against you, and you're going to only go for 2 pips of take profit.
So the other side of that answer, I suppose, if I'm not in this, so you're right. If I'm in this, I'm going to be looking to get in at the best possible PTP and get out at the next action point, which is 2 pips away, because the market that's just what it's doing.
Right. And
but
you're not going to move the needle if you're trading with a 0.02.
True. So I would increase my position size, and I would be a lot more active about getting out of my positions, recycling, get in, get out, get in, get out, get in, get out, get in, get out. With a larger market, like this sucker, even though it was brief, I would be more inclined to have a lower position size with less trades, maybe layer them in to build for a position. So that because I wouldn't be buying here and getting out here. I would be layering all the way down to this big guy, and then getting out, looking to get out at the 50% or greater. But in order to do that, I have to lower my position size and or number of trades.
So this whole time that you've been talking, I've been trading on the UJ. And I did something that I don't normally do, but it's a technique that I pull out when the market conditions are like this. And that is I put on a 2-pip take profit. And
Yeah.
I've just made about 1%. Once I close out of these trades, I'll be a little bit over 1% in this right here. So the question is, due to position size, with 2-pip take profits, how has this last hour been worth 1%?
Recycling.
I think that culminates like the gives you the answer of why position size is so important. Because somebody would look at this and say, there's not 1% in here. You know?
Absolutely could be. And one of the things I got lost in for months is the only way to make 1, 2, 3, 4, 5% is to build and get a lucky run. And that happens, but that's not a consistent belief, or it's not a consistent accuracy.
Correct.
When you have a different market, like what you were talking about just now, the build concept is not going to give you 1% because you're going to start here and you're going to wait for a breakout. And that could be 2 o'clock in the morning.
Yep.
But if you change your position size and you change your behavior on build to get in, get out, 2-pip take profit, for example, like what you just did, then let's see, what do you got? 7 pips, 5 pips, 2 pips is extremely high probability to get. And every time it comes down here, you buy. Every time it goes down here, you buy. Every time it goes down here, you buy. Every time it hits the top, you sell. Every time it hits the top, you sell. And those little nickels and dimes.
And with that move, I'm done trading.
Done.
I know, but with that concept, you're nickel and diming money into the account, just like the bank nickel and dimes it out of your account.
Mark, Joseph had a great question. Well, I actually was thinking the same thing. So it sounds like market condition is really kind of how you define your take profit.
Yes, it can. Yeah. Based on the conversation David and I just had, it can absolutely change whether I'm trading with a take profit or I'm building with a zero. And Megan has even showed me something where she'll implement both. She'll have a layer, some with take profits, some with zero take profits, to help manage how she does it. And that's what works for her. So you may want to DM her later and figure that out. Yeah, that's pretty smart. She's making some good money with it.
Yeah. And so just going back to market structure, market conditions, and position size. Look at that. Those are the rule of 3. That's what you need, right?
All these strategies and all these brand percentages and everything are all based in very foundational, simple things. If we don't complicate them and we just keep paying attention to them.
Love it. See, I'll run a little over. Are we still good, Dave, for a minute?
Yeah, I was just gonna wrap up.
Yeah. Look at that. The wrap up.
The wrap up.
Okay. So in summary for everybody, in case everybody just wants to skip to the end here, position size is basically a balance of what moves the needle for you as far as profit and what you are comfortable with. To start, you can use the guidelines of 0.02 for light, 0.05 for normal, and 0.1 for heavy with a $5,000 account. And you can scale that and to any account size. And remember, position sizing is dynamic. It is not static and changes with the market in real time based on what's happening right now. Whether we just went through some higher price cycles to some smaller price cycles for whatever reason, news happens, talking head happens, whatever. When you sit down, the market's going to change. Be sure to keep your position size in mind. Make sure it's tied to correctly to the current market that's being given to. Market structure and the KPIs are key to identify before you even place a trade for those reasons. Remember your zones where normal trading is encouraged and where light trading is warranted. Use price cycles to help determine your price, your position size. And if you're done with a trade, don't jump back in another one with the same position size. Reassess what's been happening. Look for that KPI, look at the market, look at those price cycles. Have they changed? Because they probably have. And the mastery of all arts is through seat time. If you are not where you want to be, keep trading. Just keep doing it until you do master it. And if you're having trouble finding the resolve to do that, remember your reason why you decided to become a trader. And keep telling yourself why. Carry that into each trading session. For me, it's family and freedom from that 9 to 5 that it almost killed me. God, that was awful. But when I'm down and I'm eating crow and I'm in drawdown and all 5 of my accounts are down, I still sit my butt down in front of the computer every day. I may not be on the TV because I'm mad, but I still sit down and I still do it because I know that at one point it's going to pay off for my family and my time with them.
Couldn't agree more. Very important to have that motivation, right? That's what is it for?
I agree.
That's it.
Yeah.
Thank you, Josh. I could sit and listen to you for at least an hour, that's for sure. But
But you kind of had to today.
but thank you. That's awesome. Great job.
Yeah, I know. Again, we're kind of running up against the clock. What do you think? Open up for quick questions, or I think it's very detailed. So I don't know. Quick questions. Comment. Great job. Persistence. Being said, gotta have it.
I can't wait till you teach position size 102 and do a deeper dive, because I know that you got a lot of value to add there for sure.
Well, let me go back to growing my accounts to position size 1.0.
But no, I appreciate it. Again, with just the time that you took, to put this together, time away from family, doing other things to share your knowledge with us, and truly appreciate it. There's not a community like ours out there, and we're all in it to win it together. So thank you, Josh. Really appreciate you, being able to present tonight.
For sure. I think with that, we'll go ahead and end it there, and then everybody in the hot seat, let's jump over and get some night trading, and let's go hunt for another 1%, because Josh helped me get 1% today with proper position size. So let's go get another one.
So if you made 1% while we were all working, are you going to share that?
It wasn't working. Everybody was trading, Josh.
Probably everybody except me.
We never not trade.
Or trying to peek.
Yeah, thank you again, and for those of you guys, we'll see you guys tomorrow morning for some fun trading. So again, great job, Josh. Thank you. Appreciate it.